Hello there, Adam Gower here, gowercrowd.com, and in this podcast, I'm going to be speaking to Orest Mandzy, who is managing editor at Commercial Real Estate Direct. And I'm going to do what I almost never do, and that is date stamp this podcast. Today's date is March 22nd, 2023, and Orest is a world expert, the foremost expert in the real estate markets, tracking as he does everything that happens in CMBS. And we're going to be talking today about exactly what's going on in the markets, how it's impacting commercial real estate, and comparing what's going on with banking and commercial real estate to not the 2007 global financial crisis, but actually to the 1989 collapse in markets and in values or commercial real estate values in that era. Orest very kindly put together a slide presentation. So I recommend that you actually watch this presentation, or this podcast, I should say. Go to gowercrowd.com and go to the podcast section, find the podcast with Orest, and you'll see a video there. We'll probably also put it up on YouTube. And if you are unable to actually watch it, I am also, let me just double check here. Yes, he very kindly also sent me the slide deck. Lots of very interesting charts there that you do want to have a look at. So you will find those on the podcast page as well at gowercrowd.com. Of course, I have to say it, if you've not already subscribed to the Gower Crowd newsletter, please do that when you are at gowercrowd.com. Top right, you'll see a button. Go ahead and subscribe. It's totally free. All right, let's get into it. Orest Mandzy coming up. What is going on in the markets today, and why does it look like 1989 all over again? Here he is. Orest, it's always fabulous to see you. And these are interesting times in which we live. And of course, I was so fascinated when we were going back and forth about what's going on at the moment. I was about going back and forth about, I was thinking all about, of course, 2007. And you sent me that one email, boom, 1989 all over again, question mark. All right, Orest, why is this 1989 all over again?
We like to exaggerate things sometimes, but there are a lot of similarities and a lot of differences. So right now we're not facing a credit issue. We're not facing an issue of credit. Rather, it's an interest rate issue. But the end result could be very similar. So I figured I'd put together a few slides to sort of get a better understanding of why I think this is different than what we saw during the global financial crisis.
All right, here we go. So for those listening, my recommendation is do go to gowercrowd.com, find the podcast page, Orest Mandzy, and watch. This is in video as well. So, all right, so we got some slides. Orest, go on. Sorry, I didn't mean to interrupt, but this is
not a problem at all.
Multimedia.
All you want. So,
all right.
What's the state of the commercial real estate market right now? So a couple of things are going on that aren't quite evident. Investment sales transaction volume in February was down 51%. On a year-over-year basis. In 2022, all of last year, volumes were down 15%, but that was to $729.8 billion. That's still the second highest annual volume ever. And these were at prices that we'd never seen before. So trading volumes started declining last year as interest rates hiked. You could see the Fed funds rate where it was at the beginning of 2022 and where it ended up. So right now, and today they hiked it by another 25 basis points, upper target of 5%. But a lot of commercial real estate is financed with long-term loans, 10-year loans, and those are benchmarked off of the 10-year Treasury. The 10-year Treasury hasn't seen the dramatic run-up in value in yield as the short-term rates. So pricing last year had increased by less than 1%, and in February they're down 6.9% from last February. So, which tells us that there's been a dramatic sort of pullback in pricing, and that's all driven by interest rates. And we'll get into more of that, what drives that. But it's if you have to pay more for debt, you're going to pay less for the property in order to generate the yield that you're looking for. So the expectation right now is that we're going to see a 15% or more decline in property values. Some folks have said that Barclays, for instance, said late last year projected that the value of apartment properties would decline by 20% or more. And again, that's all driven by interest rates. If you have to pay more for debt, which is a big chunk of the capital stack for a property, you're willing to pay less in order to generate the same return that you're hoping for. So the 10-year Treasury is now, or at the end of was recently 3.59%. At the beginning of 2021, it was 1.78%. So it's doubled, and that's just the benchmark. CMBS mortgage coupons have doubled nearly 6.3% recently from 3.54% in early 2021, and the bond spread, which is the risk premium that investors require in order to buy those CMBS bonds, have skyrocketed. Over the past couple of days, because of the turmoil that's taking place in the banking sector, those credit spreads had ballooned by even more than the 160 basis point median that we track. That's the number that we calculate based on a survey that we conduct every week. So it costs more and more to borrow money is the issue. And right now the yield curve is inverted. It costs less to borrow long-term money than it does short-term money, which is kind of an interesting phenomenon, and usually does not end well. So what's the result of this? Not only are credit spreads increasing and the rate to borrow, the cost to borrow has increased, lenders are tightening their credit standards. Right. So this is a graphic showing the major mortgage REITs. These are non-bank lenders. And what their lending volumes have been quarter over quarter from the fourth quarter of 2021. They've plunged to next to nothing.
That's incredible. This chart is really incredible. I mean, this is just for those who are listening and not watching. This is every single line here, which is showing total originations in terms of number of mortgages from these REITs.
A dollar balance.
Oh, dollar balance. Okay.
Yeah. Basically, but it's still significant. If you look at BXMT, a Blackstone Mortgage Trust, the largest mortgage REIT, in the fourth quarter of 2021, it originated $6 billion of mortgages. Most recently, that's not to next to nothing.
It's almost zero. Yeah.
It's just about zero in the
That's
first
incredible.
quarter. And each of those companies is saying they're taking a defensive posture. They're expecting distressed opportunities to arise. So they're holding back on lending because they would be lending at effectively the top. They'd be trying to catch a throwing knife, in other words.
Yes.
Why do that instead of picking up the knife
just
as it
waiting?
falls?
Yeah, exactly.
This is the crux of the issue, the bank and thrift sector. They hold, and it really depends on where you get the data, but we're talking trillions of dollars. So, a couple of billion here, a couple of billion there, that almost doesn't make a bit difference. But banks and thrifts, according to the MBA's analysis of Federal Reserve data, banks and thrifts hold $1.75 trillion of commercial real estate debt. That's 39% of the total $4.5 trillion of commercial mortgage debt outstanding in the country. Banks smaller than $250 billion of assets hold 70% of that $1.75 trillion. And that's where the issue is.
What proportion of banks is that are under 250 billion?
That's the vast majority. So there's 40, I forget what number it is, 4,800 banks in a country. The top 15 have more than 250 billion on assets. The rest are smaller.
Really? I see.
Yeah. So it's the vast majority of banks. We're becoming more and more like Canada in that regard, where you have 6 major banks or whatever they have up there, 4 banks, and that's it. So there's been pressure on banks, which will have a negative impact on the availability of credit. The fear and the risk is that as folks move their deposits out of these smaller banks into what they expect will be safer havens, they won't have to rejigger the asset side of their balance sheets. That might result in them either selling commercial real estate loans, or maybe just holding back on lending anew. In other words, a tightening of credit,
right?
Which this wasn't supposed to be a credit
crunch, right?
crisis. It was basically a pricing crisis. So there's 200. That's the backdrop. There's $250 billion of bank-held debt that matures this year. At $50 billion of CMBS loans mature, while senior bank loan officers are saying that they're tightening their standards. Now, that 53% of senior bank loan officers reporting tightening standards is from February, so it predates the SVB and the Signature Bank bailouts.
Does it really?
Yeah.
So I bet that's changed
even tighter now.
Yeah, exactly. Wow, these are incredible stats. This does not augur well, does it, this stuff?
No. I started compiling the data and I said, wow, this is worse than I thought.
Yeah, look at this.
No laughing matter. It's kind of,
yeah.
But for every crisis, there's a
silver lining.
Gets an opportunity. So,
yes, exactly.
So I wanted to highlight a couple of issues. Retail has been top of mind for a couple of years, for a few years now. The transition away from shopping malls, for instance, that's had a severe impact on the property markets. So we're looking at CMBS loans exclusively here. We have $24 billion of retail CMBS loans that come due through next year, and 6.1 billion of that has a debt service coverage ratio of less than 1.25%, 1.25x.
Wow!
But that's at the loan's existing coupon. If you mark that to market rate interest rates, they're all underwater.
That's incredible, really.
So that's going to require additional equity or something, which is kind of a real problem there.
Right. So it's going to require. So this is when you say retail. This is You're talking about retail centers here.
Yeah. Grocery shopping centers, shopping malls. The ones that are in most distress are typically your shopping malls.
That's really unnerving, isn't it?
Yeah, and one of the issues is, what do you do with an old shopping mall that's basically its next life is not as a shopping mall.
Right.
Some could be converted. Parts of them could be converted to apartment properties. We have a mall not too far from here that's owned by P-REIT owns it, Pennsylvania REIT, and they're converting part of it into apartments.
Well, they're quite well located, but still.
That's right. Correct. Yep. So $8.18 billion of CMBS retail loans are delinquent. 7% of all CMBS retail loans are not paying, are more than 30 days past due, which is a pretty large number. I put together some data on loans that are in special servicing. So in the CMBS sector, and we have good insight into the CMBS sector because we use Trepp's data. Loans go into special servicing when they're at high risk of default. That could be because they lost a major tenant, their cash flow suddenly declined for one reason or another, facing higher property taxes, higher insurance costs, or whatever the case might be. So we had seen a decline in special servicing, and that's the next chart on the next page. But in recent months, that number has been increasing, and a lot of that is driven by upcoming maturities. As loans mature, and they might be covering with a 1.25 ratio with a new interest rate. With today's interest rates, it won't generate enough cash flow. There'll be a shortfall, so they get tossed into special servicing. We see that retail, there's almost $13 billion of retail loans in special servicing, and another $7.5 billion of office loans. And
hang on, let's just read this chart. Sorry to jump in again. So let me just understand this chart a little bit. So there's a number of loans, balance 13 billion. Percentage of total. What's that percentage?
So that's percentage of the total of the 32.13 billion in special servicing.
Oh, I see. So the vast
Mhm.
majority
Yeah,
currently is
yeah. The
retail. I
retail
see.
comprises the biggest portion of loans in special servicing,
Hmm,
the biggest cohort.
right. Interesting. Okay. Go on. Continue. Sorry.
Sure,
Office now.
sure.
Oh,
So, and here's the chart that I was alluding to before. We
hmm,
saw a spike in loans moving into special servicing following the COVID pandemic.
hmm,
The government shut everything down. Cash flow was non-existent, so loans went into special servicing as borrowers sought some sort of relief from their lenders, from the CMBS trusts.
hmm.
So that number peaked in September 2020 and has been on a steady decline. But in recent months, as you could tell, it's kind of been increasing back again.
Hmm. Oh, this is the red line is percentage change. So that's what
That's correct.
there's
That's
like
right.
this
That's right.
sudden spike. I see. But it's
Yeah, yeah,
okay. Hmm,
yeah, yeah. And here we have the biggest risk in CMBS right now, and I would gather in across the board, but we don't have the insight that we have on non-CMBS held loans, are the floating rate loans. There are a couple of issues.
hmm,
The biggest issue is the interest rate caps. Usually when a lender writes a floating rate loan, they want some protection that the borrower's cash flow, that the property's cash flow will be enough to service the debt regardless of what interest rates do. So they mandate that interest rate caps be put in place.
hmm,
Those limit, it's like an insurance policy. If the prevailing interest rates climb above that strike rate,
hmm.
the provider of the insurance then picks up the difference. There are $109 billion of floating rate CMBS loans that mature this year. And that's an issue. A lot of those will fail to refinance given higher interest rates and maybe a lack of growth in their underlying cash flow and in the collateral properties of cash flow.
Right. So let's just drill down on this. Let me just clarify
Mhm.
exactly what you're saying. So floating, I'm reading from the chart from the slide you've got. Floating rate loans typically require interest rate caps. Those have
Yep.
become very expensive. Those
Right.
interest rate caps have become very expensive.
Extremely expensive.
Yes, like into the millions, right? They used
Yep,
to
and
be a lot less before.
I have an example here, and on a real life example,
Ah,
the
here we
Wells
go.
Fargo Center in Denver
Mm,
has $375 million, $373 million of debt against it.
hmm.
The interest rate cap is set at 3%.
3%. Mm.
Yep, yep. So that means the provider of that interest rate cap, SMBC, I believe, pays the difference between the 3% and whatever LIBOR is today, which
Ah, I
is,
see.
I'd call it 3.5 or 4.5 or something like that. The cost of the cap with LIBOR at 4.33% is $7 million annually.
That's extraordinary.
Yep. And
That's
when
a, that's a, I mean, that destroys
yeah,
buildings. Yeah.
it does. And when the interest rate cap was purchased, the LIBOR was 176, so it was out of the money. It was a nominal cost.
Mm.
The expectation wasn't that LIBOR would skyrocket to 4.5 anytime soon.
How often are those interest rate caps adjusted? How often do you have to buy a cap?
So you buy it for the life of the loan. So
Okay,
if it's a loan with a 3-year initial term and then subsequent
you
extension
buy it for
options, you
three
buy it
years.
for 3 years, and then you have to renew it or buy a new one for every extension option.
So just jump back to this
Sure,
prior
sure, sure.
slide, if you would, please.
Yep.
And so is that it? That
No,
one?
no, no. I've got a couple more.
Yeah, yeah. So this 109 billion of floating CMBS loans that are maturing this year, that means that they're coming to the end of their rate cap
Yeah,
duration.
exactly. That's right. They need to get new rate caps. So what happens in a case where you have a loan that's underwater, given the
Mm.
higher cap rate cost? The lender could work with you. Instead of, some lenders have said, okay, instead of a cap, we'll provide a guarantee for X amount of dollars.
I see.
So if the property is able to pay for the higher cost of debt,
Mm.
the guarantee doesn't get eaten into. but it's there. So it's almost a self-insurance
But or
option.
they ask for more equity, right? They just pay down the amount of debt to try and get a positive DSCR, if that's possible, even.
Yeah. That's another option. It's typically the first option. The lender will say, well, you're underwater right now. You got to bring it down to, to maintain a 1.25x coverage ratio.
And so that just right. And in a illiquid market, it's very hard to find that equity.
Yeah, that's correct. That's right. Speaking of liquidity, so there's whatever the last number is, $240 billion of dry powder sitting in investment managers' hands.
Mm-hmm.
So everybody argues that, well, there's plenty of liquidity. Just look at that. But if that liquidity isn't being invested,
right,
is there really liquidity? I mean, if that $240 billion is looking for
is waiting for the bottom, waiting for the bottom.
That's right. So is it there? That's
interesting. That's a really interesting thought, actually. Is it really liquid?
Yeah.
It's the catching. That's it. I remember this in 2007, which is, I'm looking forward to getting to the 1989 analogy in a second. But I remember in 2007, that was the problem. It's if you came out of your shell and invested in something, we were selling loans, for example, at 80% of face value, or depending on the asset class, but let's say it was 80%. People were thinking that that they were getting a bargain, but values, because they were buying at market at that moment, but values were clattering down. So it was like, okay, we're getting an 20% discount on the loan, right? And the original value was maybe 120% of the loan, or whatever, 130%, whatever it was. So I'm getting a great bargain, but prices were still coming down. So you buy it at a bargain, and the next day it was worth even less.
Yes.
That's the falling sword analogy. All right, go on.
It's interesting, and that's you mentioned the 1989 analogy. So there, folks are selling loans right now. They're trying to sell loans. Banks are particularly, and they're folks that I've spoken to say, they're taking a haircut because, but it's not a collateral level haircut. It's not because the property value has declined because of some fundamental issue, it's got a big vacancy or anything like that. It's the value degradation is based solely on interest rates. It's not worth what it was when interest rates were 3%, the property or the loan. And so the expectation is, well, it's only worth 85 cents on a dollar or 90 cents on a dollar. But a buyer, if it's, call it a $10 million loan, and someone buys it in order to get a 6% yield or whatever, 7% yield, so you buy it at, say, 90%, 90 cents on a dollar, they expect to get paid 100% at maturity. So it's kind of an interesting phenomenon.
Oh, when you buy the loan, yes, that's right.
Yeah. If it's performing, you expect to be paid at par.
Right.
And that's the big difference between now and 1989. We don't have the fundamental issues on the properties at the property level.
89. This was a deep recession in 89. Well, it's the savings and loan. But actually, let's go through the whole of your. Let's go and have a look at these. I mean,
So I wanted to highlight because Signature Bank was while SVB was a much bigger bank, their exposure to commercial real estate was not as great as Signature Bank's exposure.
Right.
So Signature Bank had 110 some odd billion dollars of assets. Almost $36 billion of that was in commercial real estate. It was a New York bank, because there's a bank that's in place there. $25.5 billion of its loans were against New York City real estate. That's 12% of the New York City commercial lending market, which is substantial.
Yeah.
And almost $20 billion of its portfolio is against apartment properties. And most of those were rent stabilized properties. Now, New York is, I've sometimes argued that New York doesn't have an apartment market per se because the government controls so much of it. The landlord doesn't control what it can generate from the property that it owns. The government does. So its book was kind of hit by a piece of legislation that was passed 4 years ago, the Housing Stability and Tenant Protection Act of 2019.
Mm-hmm.
A lot of property owners or investors in New York bought properties, older properties, say mid-century apartment properties in the boroughs or in Manhattan itself,
Mm-hmm.
with the expectation that I'm going to, as units vacate, I'll fix them up, and then I'll be able to charge market rates. That was allowed before, but this law that was passed in 2019 and signed by Andrew Cuomo then doesn't allow that. It heavily restricts how much you can increase rents
even on a vacant. That's insane. That's
yes,
even worse than LA. I don't think it was possible.
Yeah, and now there's a piece of legislation that's circulating in the state assembly rather, that would even market rate properties that are totally unsubsidized. They don't benefit from any tax advantage or anything like that. The state would propose limiting annual rent increases on existing leases to CPI or a portion of a tenant's income.
Well, we do have that in LA, Orest. I have to tell you that there are limits. Once you've got a tenant in, if it's rent controlled, you can't.
These would be market rate units. Market rate units.
Mm.
So it's it's pending legislation. Who knows whether it's going to be signed or pass? It's really hard to say. I mean, New York, like LA, is chronically short apartment units, and could that be the issue?
You kind of wonder if it doesn't make any economic sense to build them.
Yeah, why would you develop?
Yeah, you go somewhere else instead to do it. Exactly.
That's right. That's right.
That is what happened.
And that's the end of my presentation here.
All right. So now let's talk about why 1989 all over again. How is it? Because when I think of 89, I think of the savings and loan crisis. The other thing that I think of is the vast number of banks that failed in 89 compared to even 2007. I mean, there was a lot that did in 07, but you look at the charts, I mean, 89 was just this mountain of failures relative even to 07. So why is this like so much more like 89, not 07, Orest?
Well, I think and again, it's not so much a collateral credit issue, but an interest rate issue. But a lot of it is being driven. A lot will be. I think we're going to see a lot of, maybe not distress, but a lot of opportunities coming from the banks. They'll have to reduce their balance sheets, so they'll sell loans or collateral properties or whatever the case might be. But it's an interest rate issue as opposed to a collateral credit issue.
I see. So do you think that obviously this is what makes this so fundamentally different again from I think from my recollection from 89, 90 and from 2007 is that this time this is a clearly managed collapse, if you like, or fall in values. I mean, the Fed is making a conscious decision to do this to stem inflation. And do you think that I mean, they don't talk in these terms, but do you think the Fed just recognizes, especially for commercial real estate, which is such a driver of the economy, that, you know what, guys, it's time for a shakeup. You're just going to have to suck it up and suffer it, because we know that once we get everything under control, it's going to explode back the other way, and the inevitability of cycles, and we're just going to manage this one. Do you think that's possible?
Yeah. Jerome Powell wants to be Paul Volcker.
He wants to what? Be what?
He wants to be Paul Volcker.
Paul Volcker. He was right. Okay, so
this is the last time we had massive inflation, and to control it, he basically tightened the screws up.
And threw the economy into a recession.
Yeah.
Right.
Yes, this was inevitable, as you said. I mean, you have what amounted to 0% interest rates for so long. It just hyperinflated values.
Yeah, it did hyperinflate. So there's a few things that you pointed out here. second highest volume of transactions. And again, you're taking your slides down, so I'm kind of doing this from memory. Second highest volume in dollar terms in 2022 of CRE transactions.
Yep, 730 billion. Yep.
But at insane prices, right? So this was before interest rates started to go up. So do you think that this, what kind of, I know you've got them. I've been practicing this line. I know you've got them, so I want you to look into one of your crystal balls. Well, how deep do you think this could go, Orest, with commercial real estate values? You got Barclays predicting a 20% reduction in multifamily. That will blow up the multifamily market. I mean, there's a lot of people that really shouldn't have no business in it, frankly.
So and multifamily is, people have to live somewhere. So that's always the bottom of that's what prevents the market, that market from collapsing.
Yeah, but a 20%, I'm sorry, just to pause there.
Yeah.
20% reduction in values of multifamily, if Barclays is right, that is a collapse. I mean, that is going to wipe out a huge number of players in this market.
But mind you, they're not projecting it's going to happen in 6 months. Or 8 months.
So that was actually my note was when? Like what?
So it's really all a mathematical issue, right? I mean, if properties, and we know for a fact that a lot of multifamily properties traded for prices that resulted in cap rates of less than 4%.
Yeah,
there were 3.5% trades, if not lower.
Yeah,
those lower ones were done with the expectation that, well, we'll fix the units up and jack up rents by 15%, or whatever the case might be. So if you're buying something at a 4% cap rate right now, you have, well, depending on what type of leverage you have, today, that would be a negative leverage situation.
Right.
If you mark that to market, you really should be at maybe, I don't know, 6.5% cap rate.
Well, yeah, I mean, it has to be, whatever the cap rate, it has to be higher than the debt, whatever your debt.
You would expect, right?
Yeah, you would, wouldn't you?
So everybody always says, yeah, but it's all based on expectations. But we're seeing, from what we've been able to gather, there's we could expect a great influx of units across the country, more construction than we've seen in years. If I recall correctly, 580,000 units over the next couple of years or something like that.
Yeah, there's maybe even more. I see that as well. There's definitely been a rush to build. So at the same time as you've got values coming down,
right?
You've also got more supply, and demand hasn't changed, right? I mean, demand is still pent up.
That's right.
It's still stable, right? People aren't demanding more apartment units. They're just, well, not in a total sense or absolute sense. So as supply goes up, you're going to find that.
And the sort of the big offset to that is jobs. The employment picture is still relatively healthy. So unlike say during the global financial crisis, where unemployment skyrocketed, fewer people, if you were unemployed, you didn't necessarily need an apartment. You went back home or you doubled up or whatever the case might be. So there was a decline in demand for units as a result. We're not seeing that. I mean, job growth is still relatively strong, or at least I should say the unemployment rate is still strong.
Well, that was something that happened, as I recall, that was something that we saw during the 89 down was people started moving in together and actual demand went down. I remember, I was working for a multifamily developer in those days, and we were doing all ground up stuff. I was raising money actually from Japanese investors. And I remember driving around town, and it was my first rodeo in 89. And I just thought, like everybody else said, no, this time is different. I was in San Diego. This time's different. We've got all this population influx. It's never going to go down. It's different. And as I drove around town, I only realized it in hindsight. I started seeing concessions banners everywhere, right? But move in, get 2 months free. And it didn't occur to me that this was downward pressure on prices because there was so much vacancy.
Yeah, yeah, it's interesting now. Now, a lot of the data that we gather are backward looking, like most data are.
Right.
But we look at each of the REITs quite closely, and the apartment REITs are very telling because they'll
Mm,
tell you that concessions have increased on a month-to-month basis or they've decreased. Through the first quarter, generally speaking,
mm.
concessions were either flat or down across the board, if I
Really?
recall. But but just about all the REITs expect valuations to decline.
Mm. That's interesting. And
Mhm.
what is the time scale for this, do you think? I mean, how long is this going to last? My sense, just before you answer, I have
Mhm.
to express my opinion. But my sense is the second that the Fed indicates or even hints at reducing rates again, there'll just be an explosion of confidence. And that is
Yep.
when everybody, all that cash that's waiting for the bottom will go
Yep.
ballistic.
I think you're 100% right. I think everybody's looking for some sort of stability in interest rates.
Mm,
Now, a lot of folks that we talk to are looking at the start of the second half,
right. Q3
and
and Q4,
it's.
exactly.
But hope is not a good strategy, from what I've been
Mm.
told. It's
Exactly. So let me ask you this very practical perspective. How can professional investors, right? I'm talking about people who are out there looking for opportunities, not individual investors who are looking,
Mhm.
through the crowdfunding mirror, or not mirror, but lens to try and invest with sponsors. But how can professional sponsors find opportunities? You talked about, your network of people and banks, etc., selling loans. I mean, that gets me all excited. But how can you
Yeah.
find these opportunities?
Well, I think the way I hear about them is by keeping in close contact with folks in the market, be they
Mm,
the brokers or the principals at these institutions. They're the ones that everybody wants to get the highest dollar possible, so they're going to use a
yeah.
broker. If someone comes in and says, "Well, I'll buy these loans for you," unless they're in hyper distress,
Mm,
they'll say, "No, I want it widely marketed, so I get the
mm.
maybe the guy behind you will give me a better price."
You know, it's
You can't
interesting
touch
that
it
you
down.
say that. Actually, I worked for a major bank. They don't like me to talk about them. I mean, most people know who it was, but I was brought into a major bank in 2007 to help them clean their balance sheet. And one thing that I learned, because I was at the sharp edge of selling all of these loans, and I sold about 1 billion in a year, one at a time. What I learned was that actually brokers did not get the highest price. It sounds
Huh.
counterintuitive, but the reason they didn't was because buyers that had cash thought that brokers got the highest price because they marketed the loans. So if it was marketed by a broker, they didn't want to touch it.
Uh-huh,
But if it
uh-huh.
came directly from the bank, because I was sitting at the bank and my email address had that, like extension at the bank name, right,
Uh-huh.
.com, they thought this guy doesn't know anything, right?
Right,
He's
right,
just a
right, right.
banker. He's clueless. He's got no idea. And we were actually able to get prices up dramatically because the perception
Huh.
was that they were getting bargains. And when we sold, we knew that we were selling to, it was always somebody that would pay dramatically more than anybody else.
Right, right,
That was
right.
who we tried to sell to. And there's usually a reason for that, right?
Yeah,
It's
yeah.
because they like I remember warehouses, for example, industrial warehouses we tried to sell. And we get half a dozen or more offers. And then we get one that was dramatically higher. And it turned out it was the guy next door.
Okay. Yep,
Right.
yep, yep.
He understood. It was just, there was more value in it for him. He
Right,
wasn't
right,
looking
right.
for an investment. He wanted to grow his business. And we saw a lot of that,
Yeah, yeah, yeah,
actually.
yeah. Interesting. Fascinating.
Well, Orest, this is, we are in, what is it? Oh my goodness. So we've been talking so long already. We should definitely revisit this, if you're okay with that,
Oh yeah.
once in a while. I mean,
I
we
eat
should,
this stuff up, so I'm always ready.
good. So I was thinking, we should revisit when things have changed, which means, hang on, what time is it? Right. So let's wait an hour and do it again and see what happened. So let's just wrap up with this. So where we are today, we are March 20 something or other, 22nd, 2023. When do you think we're going to see really the opportunities emerge and the market turn around? What do you think is going to happen? I'm asking you to time the market.
Yeah. So that's always dangerous. So I think people who expect the market to sort of stabilize by the early part of the second half, I think they're hoping, as opposed to sort of, there's no reason for them to think that. This could last a little longer than that. It's probably, we're not probably going to see a stabilization until closer to the end of the year, I don't think. It's going to take a little while for things to shake up.
Do you think we're going to
kick the can down the road, but not too far?
Not too far, that's right. In the hope that things will turn around quickly. And do you think eventually it starts cracking? By the way, I will tell you that we're seeing, my network, and I talk to sponsors, not to banks as much. So we talk to sponsors. There is definitely stuff being shaken out. Right, definitely now.
Oh yeah.
Some incredible opportunities are already emerging. They're on the kind of periphery of the major markets, but that's inevitable. That just the worse it gets, the closer to what most people really want.
I think the one of the things that we're going to be watching very closely are the volume of floating rate loans that are coming due. I mean, if you're taking a lot of floating rate debt was done, and not exclusive of the construction loans, they were provided, because why would you get a floating rate loan if prevailing interest rates were 3.5% or 4%? You get a long-term loan. You get a floating rate loan because you expect to upgrade the property that you have, redevelop it, or whatever the case might be, or release it with the expectation that you'll improve its value and then qualify for a larger fixed rate loan. Well, a lot of those business plans are either in limbo or they're just dead. Particularly commodity office properties. If you've got a second tier office property in a suburban market, or even in a downtown market, New York is littered with these, and you took out a floating rate loan with the expectation that you'll fix it up and lease it as a Class A building, that plan might not bear fruit. So those are going to be some of the opportunities.
Yeah. Well, it's going to be interesting. Orest, let's stay in touch closely. Like I said, I'm going to try and get this out in the fastest time we've ever done it before. Which is in part why I want to stop now, because I know that we're going to do it again. But I want to get my team working on producing this. Orest Mandzy, CRE News. Actually, what's your moniker? What do you attach your moniker to these days? CRE News.
Yeah, Commercial Real Estate Direct. The CREnews.com is our URL. That's where our site is.
All right, good. All right, so from Commercial Real Estate Direct, CREnews.com. It is always an enormous pleasure to see you. Right, two bowling balls on a podcast. Like you said, two bowling balls on a podcast over here. It's good to see you. Let's stay in touch. This stuff is interesting.
Yes, sir.
And maybe we'll do another last minute one if something dramatic happens again.
For sure.
We'll take a look at the market. Thanks so much. It's a pleasure to see you.
Thank you. Likewise. Take care.
All right. That was Orest Mandzy, who is managing editor at Commercial Real Estate Direct. Super nice guy. He's always a pleasure. As you can see, really knows his stuff. These slides that he shared with us and the insights that he shared with us are tangible, actionable, and we will be having Orest on the show again, I've got no doubt, over the next few weeks and months, just to see what's going on as this wacky world starts to unfold and as the markets change almost by the hour. All right, thank you, Orest. Always good to see you. Thanks so much for being with me today. And thank you, dear listeners, for joining us also. I'll see you next time. And for now, this is Adam Gower signing off.